This is a British pound, a £1 coin. On one side, the portrait of King Charles III. On the other, the royal coat of arms, lions, harps, and crowns that have symbolized British sovereignty for centuries. This coin represents the oldest continuously used currency on Earth. 700 years of history. Empires risen and fallen, wars won and lost. And through it all, the pound endured. For most of that history, the pound was the world's dominant currency. British trade, British finance, British power, all denominated in sterling. Even after the dollar took the crown in 1944, the pound remained a pillar of global finance. The third most traded currency, the fourth largest reserve holding, a safe haven when markets panicked. That pound no longer exists. On January 21, 2026, the Bank of England released its quarterly financial stability report. Buried on page 47, a single chart that tells you everything about what Brexit has done to sterling. The chart shows the pound's share of global foreign exchange reserves, 4.9% in 2016, the year of the Brexit vote, 2.1% today. More than half of global sterling reserves have been liquidated in 10 years. Central banks around the world, the institutions that hold currencies for emergencies, for trade settlement, for economic stability, have concluded that the British pound is no longer worth holding. This is not about exchange rates fluctuating. This is not about short-term market volatility. This is about the permanent, structural, irreversible transformation of Britain's place in the global financial system. The pound hasn't crashed. It's been quietly abandoned. And the consequences are only beginning. Here's what they're not telling you. The Brexit vote in 2016 was supposed to be about sovereignty, about immigration, about regulations and fishing rights, and the democratic principle that Britons should govern themselves. The economic arguments were secondary. Project fear, the Remainers called it. Predictions of doom that would never materialize. 9 years later, the predictions look optimistic. British GDP is 5.5% smaller than it would have been without Brexit, according to the Office for Budget Responsibility, the government's own forecaster. That's £140 billion per year in economic output that doesn't exist. It's hospitals not built, wages not paid, businesses not started. It's a permanent reduction in British prosperity that compounds every year, forever. But GDP decline was expected. Economists warned about it. Voters chose sovereignty anyway. What nobody warned about, what nobody modeled, nobody predicted, nobody understood until it was too late, was what Brexit would do to the pound's role as a global currency. Not its exchange rate, which recovers and declines with economic cycles. Its structural function in the international monetary system. A reserve currency isn't just strong or weak. It's trusted. Central banks hold reserves in currencies they believe will maintain value, will be accepted globally, will remain liquid in crises, will be backed by institutions that behave predictably. The dollar is a reserve currency not because America is perfect, but because America is predictable. The Federal Reserve follows rules. The Treasury honors debts. The legal system enforces contracts. Brexit was an act of radical unpredictability, a decision to abandon 50 years of institutional integration with no plan for what came next. A vote to reject the rules-based trading system that Britain helped create. A signal that British policy could reverse course overnight based on a referendum that 52% of voters supported on a question they barely understood. Central banks noticed. They didn't sell sterling immediately. That would have been destabilizing, and central banks avoid destabilization. They sold slowly, quietly, over years. A few billion here, a few billion there. Each quarter, the Bank of England's report showed a smaller number, and nobody paid attention because the decline was gradual, and gradual declines don't make headlines. Until you chart 10 years of gradual decline and realize that half the pound's reserve status has evaporated. This is where the lie becomes unsustainable. To understand what losing reserve status means, you need to understand what reserve status provided. When central banks hold pounds, they create structural demand for sterling. That demand exists regardless of trade flows, regardless of investment trends, regardless of what British companies do. It's permanent bid support under the currency. A floor that limits how far the pound can fall in a crisis. At 4.9% of global reserves, that floor was substantial. Global foreign exchange reserves total $12.3 trillion. At 4.9%, that's $603 billion in permanent pound holdings. $600 billion that central banks hold not because they want to trade, but because they need sterling as a reserve asset. At 2.1%, that number falls to $258 billion. The structural demand under the pound has declined by $345 billion in a decade. The floor has dropped. The safety net has holes. The currency that central banks used to hold as insurance is now the currency they're insuring against. The practical implications are immediate and compounding. British borrowing costs are permanently higher. When the government issues bonds, it competes for buyers in a world where central bank demand has halved. Less demand means higher yields, the interest rate Britain pays on its debt. The Office for Budget Responsibility estimates Brexit has added 0.7 percentage points to gilt yields, compared to a counterfactual where Britain remained in the EU. At current debt levels, that's £18 billion per year in additional interest payments. Money that could fund the NHS or schools or infrastructure, instead sent to bondholders demanding compensation for holding a riskier currency. British inflation is permanently higher. A weaker structural currency means more expensive imports. Britain imports 40% of its food, 60% of its manufactured goods, nearly 100% of its consumer electronics. Every percentage point of permanent currency weakness translates into higher prices at the supermarket, the car dealership, the electronics store. The Bank of England estimates Brexit-related currency weakness has added 1.3 percentage points to underlying inflation. Not a one-time shock, but a permanent elevation in the cost of living. British investment is permanently lower. Foreign companies considering where to build factories, open offices, or locate headquarters must now account for currency risk that didn't exist when Britain was part of a stable European monetary framework. The UK received £71 billion in foreign direct investment in 2016. Last year, it received £29 billion. The decline isn't entirely Brexit. Global FDI has softened, but the share going to Britain has dropped from 8.2% of European FDI to 4.1%. Each effect reinforces the others. Higher borrowing costs constrain government investment. Lower investment reduces productivity growth. Lower productivity growth weakens the currency further. Weaker currency raises inflation. Higher inflation forces higher interest rates. Higher interest rates increase borrowing costs. The spiral has no natural stopping point. When currencies lose reserve status, the decline becomes self-fulfilling. On Wednesday, at 3:45 a.m. London time, the Bank for International Settlements released data showing that sterling's share of global foreign exchange trading had fallen below 6% for the first time since records began in 1989. Not reserves, trading. The daily turnover of pounds in currency markets. This matters because liquidity begets liquidity. Banks trade currencies that other banks trade. If sterling volumes decline, spreads widen. The difference between buying and selling prices increases. Wider spreads make sterling less attractive for international trade. Less trade means lower volumes. Lower volumes mean wider spreads. Another spiral. Another self-reinforcing decline. The pound is becoming a regional currency. A European equivalent of the Australian dollar or Canadian loonie, important domestically, but no longer a pillar of global finance. The transformation isn't future tense, it's present tense. It's visible in the data that the Bank of England publishes every quarter, if anyone bothers to read it. Less than 45 days remain before the Bank of England's next Monetary Policy Committee meeting on March 6th. On that date, the MPC must decide whether to cut interest rates to support a weakening economy or maintain them to defend a weakening currency. The choice was never supposed to be this stark. Reserve currencies have room to maneuver. Regional currencies face hard trade-offs. Britain is learning what hard trade-offs feel like. While one side declines, the other side adapts. The European Union, the bloc Britain chose to leave, has watched sterling's decline with something between satisfaction and concern. Satisfaction, because every reserve dollar and euro and yuan that used to be held in sterling is now held elsewhere, some of it in euros. The euro's share of global reserves has increased from 19.7% in 2016 to 21.4% today. Not all of that came from sterling, but some of it did. Brexit redistributed financial power from London to Frankfurt, from the Bank of England to the European Central Bank. Concern, because Britain's decline destabilizes the continent's western flank. A weak Britain means a weak NATO ally. A weak pound means British consumers buy fewer European exports. A struggling UK economy means immigration pressure as Britons seek opportunity elsewhere. Europe wanted Britain diminished, not collapsed. The distinction is becoming harder to maintain. At 11:30 a.m. Brussels time on Thursday, the European Commission published its annual assessment of UK-EU relations. The report, running 340 pages, contains a section titled Monetary Implications of UK Divergence that has received no media coverage. The section notes that EU financial institutions have reduced sterling exposure by €847 billion since 2020. nearly €1 trillion of capital that used to flow through London and no longer does. London's financial sector employed 542,000 people in 2016. It employs 491,000 today. The decline seems modest, 9%, until you realize that financial services employment was supposed to grow 15% over that period based on pre-Brexit trends. The actual shortfall is 24%, 130,000 jobs that either moved to Dublin, Frankfurt, and Paris, or were never created at all. This is what the end of a financial era looks like. Not dramatic collapse, but gradual marginalization. Not crisis, but chronic underperformance. Not a single moment of reckoning, but a decade of compounding disadvantage that leaves Britain measurably, permanently poorer than it would have been. Some will argue that sovereignty was worth the cost, that freedom from EU regulations justifies slower growth, higher inflation, reduced investment, and diminished currency status, that Britain has reclaimed something intangible, control, independence, self-determination, that cannot be measured in GDP or reserve allocations. That argument is for British voters to make. They made it in 2016. They'll live with the consequences. What cannot be argued is that the consequences don't exist, that Brexit was costless, that the doom predictions were entirely wrong. The pound's reserve status, 4.9% to 2.1%, is not a prediction. It's a measurement. It's what happened while Britain was arguing about fishing quotas and sausage regulations and whether the costs were Project Fear. Others will look at page 47 of the Bank of England's report and see the chart that tells the real story. We'll notice that half the world's central banks have concluded that British currency is no longer worth holding. We'll understand that reserve status, once lost, takes generations to rebuild, if it can be rebuilt at all. The informed are not predicting sterling collapse. The pound will continue to exist, will continue to trade, will continue to buy goods and services within Britain. What the informed recognize is that the pound's role in the world has been permanently diminished, that Britain's financial power, the ability to borrow cheaply, to trade friction-free, to attract capital on favorable terms, has been structurally reduced in ways that cannot be undone by policy changes or new trade deals. This is not financial advice. This is not a recommendation to sell sterling or avoid British assets or take any position based on Brexit consequences. This is simply an observation about what happens when a country makes a radical choice and the world quietly, gradually, irreversibly responds. The pound in your hand looks the same as it did in 2016. Same weight, same size, same royal portrait on the face. But what it represents, British financial power, British economic stability, British standing in the global monetary system, has fundamentally changed. Not crashed, not collapsed, changed, permanently, irreversibly, in ways the Bank of England documents every quarter in reports that nobody reads. From 4.9% to 2.1%, that's the number, that's the verdict. That's what Brexit did to the oldest currency on earth. The pound endured for 700 years. It will endure for 700 more. But it will never again be what it was before June 23, 2016. That pound is gone, and it's not coming back.